So, hi everyone. I'm glad you could join us today for our session. I'm Jonathan Serro, co-chair of the Financial Literacy Subcommittee of SRAR's Equal Opportunity Housing and Diversity Committee. My co-chair, Kenyah Hughes, will be leading today's discussion, setting financial homeownership expectations. We have an event next week on September 21st covering wealth building at 11 a.m. And we have another event on September 29th at 1 o'clock covering mortgages. We hope to see you there. Now I'd like to turn it over to our chair of the Equal Opportunity Committee, Tisha Janigian, for a few words and to introduce our panelists.
Hello, everyone. Thank you for joining us for this event today. We have Kenyah Hughes, who is the co-chair, as Jonathan mentioned, and we have Debarah Hendrix and Melvin Fields. Melvin is the senior loan officer for Franklin Loan Center, and Debarah Hendrix is the loan officer assistant. They have both been in this industry for over 25 years and are going to share their wealth of knowledge with us for this event today. Thank you for joining.
Hello, everyone. How are you? My name is Kenyah. I am the co-chair along with Jonathan Serro for the Financial Literacy Committee. We are a subcommittee of the Equal Opportunity and Housing Committee. And so we're so excited to just bring you guys a series on financial literacy. When we talk about financial literacy, or when we are beginning to break that down for our clients, there are so many things that we do cover and we have to cover, but there are often a lot of things that we don't think about covering, or some agents don't realize it's important to cover. As we are agents and we have this ethical duty to help inform the communities that we work with every day and the people that we encounter, part of our goal and job is to make sure that we're setting them on the best financial planning or the best path to be able to expand on their investment portfolios, understand what they're undertaking, and be in a position to continue to move forward and progress as their portfolio expands in whatever way works for them and their family. So I have a really interesting question for you guys. How quickly can you spend $61,690? How quickly can you spend $61,690? And what would you spend it on? So that is the average cost for an American relocating in the United States locally. That number can double for someone who's moving out of state. One of the things that we often talk about are down payments and closing costs, and we'll talk a little bit about, insurances that come up or things like that. But we don't often talk with our clients about how to prepare at the beginning of their journey and what to do to make sure that they're on track for keeping themselves on a decent budget after the purchase of their home. Now, there are so many factors and variables that go into homeownership over the years. We find that so many things can happen in the process of you owning or someone purchasing and owning a home. And we're not going to have all the answers to that as their agents or as their vendors, as those who do just the different things that need to be done in the homeownership process. However, we can try our best to preemptively prepare our clients for that journey and make sure that they are ready for what may come their way during their journey in homeownership. So one of the things that we often talk about is that down payment, right? And that's the largest expense that a homeowner will have when they go to purchase their first home. We know that typically that down payment can be anywhere from 3.5% to 20% of the purchase of their home. We also talk a little about closing costs with them, right? That's that 5 to 6% of the total loan amount that they're going to pay to bring their home loan to a close and be able to secure that home. Things that we don't often talk about with our clients are the expenses that it takes to actually make that move. Again, for someone who is relocating locally, they can anticipate about $2,300 just to get a moving company in to begin to load up their things and move it. That's if you're within about 100 miles of relocation. If you go outside of that, that number can actually double for a lot of our clients. Those are expenses that oftentimes are not thought about when a client is going to make that move. We don't talk, we should be talking more about those reoccurring monthly expenses, the HOAs, the utilities, preempting our clients when we are preparing them for that first time home, preparing that first time home buyer for the purchase of their first home. If they're moving in a condo versus a single family home, landscaping are things that should be talked about and discussed with the client as an expense that should be added into that budget. As you partner with your lender and you begin speaking with your client about what they can actually afford to purchase versus what they qualify for, those are core things and core expenses that do have to go into that conversation so that you can make sure that your clients aren't just purchasing something without knowing what they can truly afford and be able to live on and with after that purchase is complete. And then we want to talk a little bit about the annual expenses for maintenance. The average home will take between 1% and 6% of its annual worth or of its total value in maintenance per year. So for a typical home value in California at $955,000, to maintain that home, they're looking at somewhere around $10,000 to $30,000 per year to maintain their home. Those are things like having the stucco redone, repairing braces, looking at the roofing, looking at studs, termites inspections, pest controls, anything of that manner to keep the home maintained are all things that should be talked about and balanced into that annual expense for maintenance for the year and the years to come. That percentage, according to NAR, increases about 0.25% every year. So the older the home gets, we know that there's typically a little more need for maintenance and things like that. So these are topics that I just want to encourage, and our financial literacy committee would like to encourage everyone to continue talking with their clients about more often as they're preparing them for this first purchase, or sometimes even if it's just a person who hasn't purchased in a long time. It's an educational aspect that we believe is important to talk about. These are things that'll set the foundation. These topics will set the foundation for your clients as they continue, like I said, on their journey to begin to expand their portfolio investment. It's a great way for them to be able to gauge and see what their expenses are year over year, what for those of you who are interested, or for anyone who is interested in being a landlord or decides to do house hacking or duplexes, things like that. These are extremely important expenses to take into effect to understand how their money can be working for them, what to make sure they need to have in the bank in order to feel secure and safe when they purchase their first home and they're looking to just begin making sure that they're financially set and can sustain themselves in the home. Quite often, homeowners move into their homes without having a trajectory or a projection of how to actually maintain it. And as a financial literacy committee, as a group, one of the things we really wanted to make sure we were able to highlight to all of our agents and affiliates are ways that you can continue having these conversations and topics that we should continue conversing with our clients on so that we can make sure that they're financially prepared and ready to actually step into homeownership. So with that being said, Melvin and Debarah are here. They are two amazing panelists that we have with over 50 years of experience in lending, in working with clients, and seeing some of the most challenging situations and finding solutions. So we are so honored to have them here today to talk a little bit more about what they've seen in their experience and how they best prepare their clients from what some would consider worst case scenario to best case scenario, and getting them in the position to purchase a home and sustain homeownership throughout the years to begin building their portfolio. So Melvin and Debarah, at this time, if you guys can just talk a little bit about what you've seen and some of the trends that you've used to be able to successfully help your clients maintain home ownership.
Well, thank you very much. I appreciate the introduction. And I just kind of wanted to talk about a few different topics. The first being is the first question most clients ask is, how much house can I afford, and how we break down that process of figuring that out. So, I mean, when a borrower comes to it and they want to know how much of a house can they afford, there's a couple methods we look at. I mean, if they're a W-2 employee or if they're self-employed. With a W-2 employee, we pretty much just use the gross income that the borrower makes. Say, for instance, their gross income is $10,000 a year, or excuse me, $10,000 a month. That's $120,000 a year. We're allowed to use, and I'm sure you guys probably heard of the debt to income ratio. In most lending cases, the debt to income ratio is allowed to go to 50% of a 50% debt to income ratio. And how we determine what's encompassing the debt to income ratio. So if a person makes $10,000 a month, 50% of that is $5,000. That's $5,000 that we're allowed to use towards a mortgage and all their debts. So say, for instance, and we only use the debts that's encompassed on the credit report. Only debts, because a lot of people say, well, I have electric bill and that's $300 a month, and I have cable bill, and we're only looking at what's reporting on the credit report. So say, for instance, if we, like I said, we have a $10,000 gross income, 50% of that is $5,000. So that means all our debts and mortgage and bills have to encompass within that $5,000. Well, if in that $5,000 we have a car payment of $4,000, a car payment of $400 a month, and a couple credit cards, you know, you got one credit card for $50 a month, another credit card for $50 a month. So you have a total debt that's reported on credit of $500. So we take the $500 out of the $5,000, that leaves us with $4,500 a month that we can use towards a mortgage. And that's how we determine what a borrower can afford towards a mortgage. And that's pretty much just a basic breakdown of how we compute a W-2 employee. Self-employment borrowers, how we determine what they can afford is we use their tax returns, and we average the tax returns over the last 2 years. And that determines what we can use for monthly income. We average it over the last 2 years, and then we divide it by the 24 months. And with that, that's how we determine your affordability there, with the same basic breakdown. We take the monthly income and we deduct your liabilities. We deduct the liabilities to come up with what you can afford a month. So I know I was kind of running through it a little bit here, but I'll be available during questions and answers to break it down even further. You know, there's some do's and don'ts, and I'm gonna let Deborah take over and kind of cover the do's.
Okay. Hello, everyone. My name is Deborah, and I'm going to discuss what are some of the best practice in preparation for home ownership when applying for a mortgage. We have our do's and your don'ts. So on your do, you ensure that the application is completely, fully accurate, and honestly. You also make sure you discuss with your loan officer where the funds to close are coming from and which accounts you are using to wire it or deposit any of the funds to be used. These are our do's. Then we have our list of your don'ts. You do not change jobs, become self-employed, or quit your job. Number one. Number two, you do not use up your charge cards or let your account fall behind. You do not spend money you have set aside for closing. Do not change bank account. Do not have a cosign for any loans. In other words, what I'm saying, when you're in a process of purchasing a home, we ask all our customers, please do not co-sign for any loans while you're in process. One of our biggest one is that you do not buy a car or a truck or anything in that matter of a loan process. You also do not pull cash advance on your credit cards and deposit into your bank account. These funds are not eligible for the use of funds to close. You do not request student loans deferments during home buying process, as this may cause delinquents on your credit. Also, you do not use business funds for closing funds without first checking with your loan officer. Also, you do not make cash deposit. You always speak to your loan officer. And the reason why we're saying this, you guys, because all of this could impact your loan approval during the loan process. So it's very important that you do not do none of the don'ts and you talk to your loan officer of any of these matters.
So the next thing I just want to talk about is how do we deal with coaching and nurturing credit challenge clients? And as you know, dealing with credit, every client has a different credit profile. And Deb and I, like I said, we have over 50 years of combined experience in reviewing credits and stuff. Each credit presents its own challenges, but I can tell you that we use tools like credit simulators, rescoring tools and stuff to help people improve their credit score. And just by looking at someone's credit score, we can pretty much let a person know exactly what they need to do to improve their credit. Sometimes things are a little bit more challenging where it requires a little bit more work. And that's where we work with the credit professionals to help us to maintain a relationship with, if it's going to take a client 6 to 12 months. But in most cases, Deb and I can look at a credit report and let a person know exactly what steps they need to take to improve their credit and exactly the results that they'll get from it. Like I said, with the use of tools that we have with credit simulators and the ability to rescore credit and stuff like that. So the big question is, how much money should I save up before purchasing a house? And that situation can be complex depending on what type of financing you are trying to obtain. The down payment requirements for FHA financing is 3.5% at a minimum. And for conventional financing at a minimum, at least 5%. Sometimes there's options for as little as 3% conventional financing. But so down payment requirements can be anywhere from 3.5% to 20% down, which is for the best rate and best financing options is with 20% down. So, and then, you have the cost of getting started. You have the cost of appraisals. You have the cost of home inspections and stuff like that. So it really depends on what type of financing that a person is going to obtain that will help them determine how much money they can save. But I tell people as a general rule, and then there's other options too to help you with down payment and stuff, like down payment assistance programs and stuff. So I tell people as a general rule is to try to save at least 5% of what the purchase price that you're trying to obtain. And that way they can have most of their bases covered initially when it comes to saving. That's pretty much it that I had to cover. Like I said, I'm available for more questions and answers, and I apologize to kind of skip around, but I'm not much of a presenter.
Well, we're grateful for the information you did give us. Was there any questions for anyone pulling up the chat now? Did we have any questions for Melvin or Deborah regarding the homeownership process? taking your clients through that process and how we can preemptively, or Melvin, even if you can touch on how can we make sure our clients are prepared when we bring them to you?
How could I? Well, you want to explain, because a lot of clients don't understand all the costs that's involved in purchasing a house. So, with the down payments, like I was saying, with home inspections and appraisal costs and earnest deposits. So breaking that down and being able to explain that to a client is very helpful.
And also, I'm going to piggyback on that, and also their credit as well, Kenyah, to make sure that their credit is not behind or not in delinquent. That's very important as well. We would need to know that up front as we're doing taking the application. We can go over to help them get that straightened out, because that's very important too.
Thank you. And Jonathan, I see you have a hand up. Did you have a question?
Sorry about that. I do. Thank you. And Melvin, Deborah, I just want to thank you, first of all, for taking the time. Question for you, Melvin. If you're self-employed and you have decent cash flow, but you're also taking a bunch of deductions to maximize your tax benefit, how, if at all, does that impact your ability to secure a loan?
That's a very good question. It does impact it a lot, because a lot of people say, well, hey, I made $100,000 in 2022 or 21, but they wrote off 80,000. We as a lender is only going to give you credit for the $20,000. So that can be very impactful. And that was a good question, is your expenses and your write-off is counted against you big time. And I know as a self-employed person, the object is to try to write off as much as you can. But when trying to obtain mortgage financing, that sometimes hurts you, because like I say, if you say that you make $100,000, but you wrote off $80,000, then we're only going to give you credit for $20,000 of income in that year.
Yeah, I just wanted to say thank you both for presenting today. And I do know that you really do help people with making sure that they fix any credit issues before they come on there. But I think something that I found happen quite often, and I'm curious if you do, and when I bring clients to various lenders, they find out what they qualify for, but then they always forget to say, hey, this is what I'm comfortable paying, like budget wise, because there might be the other factors that are not in the credit report that you had mentioned, Melvin. So do you guys kind of review all of that with the clients, as well as like making sure that they're staying within what they're comfortable?
Yeah, and that's the first thing I tell people a lot too, is that you want to be comfortable. I can say, hey, you qualify for $600,000, but do you really want a $600,000 mortgage payment? You know what I mean? So you try to be clear with people on what they're comfortable paying a month.
And Melvin, is there any tip or rule of thumb that you typically have? I know we say that homeowners should want their payments to be within about 30% of their income. Is there any tips that you can give on how we as agents can make sure we are having that gentle conversation with our clients? I'm sure we all can attest to having a client who wants the $1 million home and wants, a couple $100 in payment. So what is that conversation like? And how should we as agents be preemptively having those conversations as we are prepping our clients and bringing them to you guys as our lenders?
And like I said before, you really want to talk to them about where they're comfortable at, because who wants to be, house poor? but you really should just have that conversation just where they're comfortable, where they're going to be comfortable at a month. Like I said, because they can qualify for more. We can, like I said, we have the flexibility to go all the way up to 50% debt to income ratio, which is 50% of their income. And that's how much we can qualify, but whether they're comfortable paying that amount up to that amount is a different story. And that's an individual question that, definitely have to be addressed with people individually. to determine what that comfortable amount is. But you're right, though. That's a general rule. They say 30% of your gross income, your mortgage payment shouldn't exceed that, but it's really a comfortable level.
Thank you. We had a few, Susan said this was great. Thank you. This info is extremely helpful. Thank you so much. And then we had one other question. Is there a limit to what a person, I guess is there a limit to the amount that an FHA could be applied for? So I guess they're asking, is there a limit to the FHA loan or a maximum on the FHA loan?
Yes, and that's determined by certain counties,
Okay.
the maximum loan amount.
Well, did we have any other questions or comments from anyone? Tisha?
Yeah, I wanted to talk about, do you guys advise like locking in the interest rates since things are changing so quickly these days? Talking about the difference between like the adjustable and the fixed rates and all, like, how do you handle that conversation with clients?
And like I say, every client situation is different and each client has different needs. But when it comes to rates and stuff like that, yes, this is a very volatile market now where rates are changing. Unfortunately, they're changing for the worst these days. And like I say, each client presents its own different challenges as far as what their needs are. But they're, whether they go with a fixed rate or a variable rate, fixed rate it's more something that you're looking to stay in more long-term. And it gives you that peace of mind to have a fixed rate that's not going to change over time, especially in a crazy market like now. And then adjustable rates, which are ARMs, are a little bit more volatile, and it's more for a buyer who's really got short-term goals and just looking to get in something with the least amount of payment and on a short-term basis. So, and like I said, that comes with each individual client, depending on what their needs are, whether we suggest a ARM or a fixed rate.
This time I remembered to unmute. One question for Deborah. So I was thinking about the do's and don'ts that you went over earlier. And, let's say I do a don't. And
We do have some clients that does that.
Let's say I do a don't. And, I take out a loan or I run up my credit card. Like, is there sort of a penalty box period where you have to wait, or like you can repair it, or any sense of like how long does it take to recover from something like that?
Again, that just depends. That's why we put it out there in the beginning when we do sit down with our clients and explain to them the reason why you can't do this at this time while your loan is in process, because it can stop. It can stop right there at the table. So it's very important, that this is one of the main things that we speak with our clients with, all the don'ts you do not do. That's very important. It's very crucial because it will have an impact, a major impact. I have seen loans that I have worked on personally myself. We did real good when it gets all the way almost up to closing, came to a complete stop because that particular customer may have co-signed for someone or went over the limit on their credit card. So it does affect your debt ratio, LTV, it affects all of that. So that's very crucial that you stay behind. But during the process, we are holding our customers' hand. We're staying side by side with them, and we constantly review to make sure.
So I want
to
flip the script a little bit. We've talked a lot about those first-time home buyers. We've talked about while we're in that escrow process, but I want to highlight what options we have to give our clients that we're taking on who have gotten themselves into the troubles and done some of the don'ts and are maybe in a position where they may need to sell their home or they need to find some other options. So can you guys just talk a little bit about what that looks like for the current homeowner who may find themselves in a troubling area, what options might they have or might they be able to explore, and how does or what that looks like for them on being on that side.
Go ahead, Melvin.
Can you say that again? I'm sorry,
I can hear.
Yeah. So what does that process look like for the family or the homeowner, the current homeowner who may have gotten themselves into trouble and are looking at options or may need, some resources to kind of help them get out of that? What are some of those conversations that you're having, and what options do they have?
when they find it as a homeowner finding themselves in trouble?
Yeah, in financial trouble.
Oh, okay.
Well, there's, like I say, and it's so hard because it's such a broad range, when you're dealing with individual clients, but you try to help them out with financial options, whether it be, getting a family member to come on and help them out, or different financial counseling that they can have access to, maybe refinancing to a different mortgage product that may help them, so it's really an individual assessment of whatever their situation is.
Mhm.
But like I said, there's a bunch of different resources as far as housing counseling. A lot of lenders have loss mitigation practices that they have that they can help clients that's in trouble. So it's really just each individual case, what it may be. But there are a bunch of different resources to keep people that's in trouble.
And would they just go to their lender for that? Do you have a set of resources that you give to clients or that you utilize yourself?
I mean, I try to establish a relationship with all my clients that we work on, Deborah and I, and to where they can be a resource, where we can be a resource throughout their life, the rest of their life, when they run into trouble or if they have questions and stuff like that.
And for anyone else, could they just typically go to their lenders for questions about things like that if they?
Mhm.
Yeah, that's the first thing I would advise a client is to reach out to the lender to see what workout options they have available. Because like I say, these days, a lot of lenders have been trained on, from the whole COVID response and stuff like that, has been trained on different loss mitigation practices that will help them, keep their house.
And one more other thing that we do once, even though like if we have some of our clients and they get into their dream home, we don't let them go right then and there. We do follow-up calls. We check on them within 6 months to 12 months to see how things is going. The budget, the financial, if any type of system we can have, or direct them to do like a debt consolidation. They max out their credit cards, try to get in one payment. So we just don't let them go. We constantly follow up with our clients.
Yeah. Which is so important, even for us as agents, making sure that we're following up with those clients. One, because that's where our referrals are going to come from. That's
right.
Where we continue to expand and grow. But one of the best things, or the best way to look at what we do, is looking at the relationship aspect. We're there for the events that happens during their lives, not just for the moments that happen. So
exactly.
When we're there, we're in tune, we're talking to them, we're following up with our clients, we're being able to be more of a resource than sometimes we may actually realize, because we can tag team and stay looped in with their lenders and things like that to make sure that they're able to sustain themselves and they have resources for the small things that happen, so that it doesn't have to become a big thing later on. So Melvin and Deborah, we appreciate your time so much. We're just, we're grateful that you came in at this time to talk with a lot of our agents and affiliates on ways that they can continue contributing to the sustainability of homeownership. Did we have any other questions or comments from our other panelists here today? I don't think we had any more questions in the chat. Well, this was all from us. We're actually finished up a few minutes early. Thank you all so much for coming out today. I hope that this was helpful. I hope you walked away with something that was able to contribute to the better building of your business and resources for your clients. So we appreciate you all, and we're wishing you a wonderful day. Don't forget, we have our next event coming up next week. So we look forward to seeing you. Bye.
Thank you so much.
Bye, everybody.
Thank
Thank you
you
for
for having us.
joining.
Thank you.
Bye.
Bye-bye.